Today's topic, you should favor pre-tax savings in your accumulator years as a high-income household. Very popular question. I'm actually surprised on how popular it still is. Again, knowing our group, high-income households, mostly physicians, we always are emphasizing why pre-tax makes a lot of sense in almost all scenarios. But sometimes you want to dig a little bit deeper. And because this question comes up so many times, whether it's from new onboarding clients, whether it's from our other presentations, whether it's through YouTube, whether it's through our weekly newsletter on those questions, whether it's us at speaking engagements, it comes up quite a bit, whether it's pre-tax, Roth, why this, why that. So today, we add more context to it. So stay tuned. That's all coming up next. All right, before we get into it, as always, quick favor, if you haven't subscribed to the channel, please do so now. Click on the little bell icon, get a notification every time we release a new video to continue to increase your financial IQ. We got you. Click on that. That's it. That's the pitch. Okay, first and foremost, let's talk basics. Basics are this. What are we even referring to when I say pre-tax or Roth? Pre-tax is accounts that you are saving to and you are getting a tax deduction on your pay stub or your 1040, your tax return, and then you invest it. It grows tax deferred. You're thinking, this sounds great. But hold on. When you go to pull it out, Uncle Sam's giving you a little wave. Still owe Uncle Sam. That's pre-tax savings. Who are the big hitters here? Really for, again, our main audience per se, 401ks, 403bs, 457b plans. So any of those pre-tax qualified accounts that you're used to hearing about. Roth. Well, usually when this question comes up, it's usually based on like, hey, I also have this Roth 403b. But Roth is the exact opposite. Roth, you are putting after-tax dollars into your investment account. And then when you go to pull it out, Uncle Sam's not there to wave. You already paid him at the door. So you're good. You're already in. You've paid Roth. You paid your taxes because of the Roth. Now, remember, you know a topic that we love. We love backdoor Roths, one of my favorite topics. Remember, backdoor Roths kind of work a little bit different here because you're actually making after-tax contributions, and then it's getting to the Roth. So it's backdoor Roth. You're not wasting any pre-tax dollars. So I always emphasize that because that's one of my favorite things about the backdoor Roth is you're not wasting any pre-tax dollars to do a backdoor Roth IRA. Now, I'm not going to talk about backdoor Roths at all the rest of this video, but I do like to emphasize that because they are completely different. And we will likely talk about something called Roth conversions. Actually, let me rephrase that. One of my best parts of this video is the benefits of Roth conversions. Again, different than how we look at backdoor Roth. So for now, love the topic of backdoor Roth. Let's sit it to the side. So we're really thinking of, hey, Chad, I can do a regular pre-tax 403b or a Roth 403b. Tell me why you think pre-tax should be better in most circumstances, right? General audience here on YouTube. So let's get into that. So first and foremost, question always comes up about tax rate. So now I want to share my screen. We always get good feedback on screen share. So let me share to show you a really good chart. If you're in the physician community, you might not know of this, but Michael Kitchis is one of our favorite resources, if not probably the most popular, the best resource out there in terms of research, knowledge, just a wealth of knowledge, him and his entire team. So I'm actually going to share a chart from one of his blog posts that was actually on this topic from a little bit later in the year 2024. We are now recording this in about mid-2025. Let me just share this with you all. So what are we looking at? These are the top marginal tax rates from 1913 to 2023. And when we're talking clients, presentations, whatever the case would be, we tell everyone, hey, historically, we're at pretty good lows here, right? So you can see here, we're down in this range here. That's pretty low. Now you're probably thinking, holy smokes, you're telling me there used to be a 90% marginal tax rate? There was. Now, to add some context to it, I believe the number was back at that time frame to even hit that, you got to adjust for inflation, right? Current dollars, present value of that number would have been about $2 million per year in income. Now, while some of you may say that's a lot of money, I would argue, depending on where you live, you get a dual physician household, two good specialties, not a crazy thing. You don't see it every day, but not crazy to have, your billionaire family, I think when people think of that number, like, oh, wow, they must be, multimillionaires. It can depend, right? So that's not a crazy number. Now, let's add some more context to it. So right now, we are historically low tax rates. So could they go up? They certainly could. You take a look at our deficit, certainly could. My theory has always been, I feel like tax rates are a lot more sticky today, right? These politicians, between tax brackets and Social Security, you go after either one of those too heavily, you have a good way to not get elected. So it feels a lot more sticky today. And I don't know if that's just, how quickly things can travel in terms of social media, but when these topics come up, it's very sticky. Now, do you see 2% swings here or there? Yeah, not uncommon for, Republicans to come in and say, hey, highest bracket's 37. Democrat comes in and say, no, it's 39. Little swings here or there, while we still are always aware of those, that's not a crazy swing. So they're more sticky today. So I guess my point there is, I don't think we ever get back into these super high brackets, or if we do, it's likely a massive number to get there. So taking that into account, let's kind of come back to our overall thinking here. Stop this share. I think that chart's helpful to kind of see where it's been. Go back here, even before we leave. It's kind of fun to look here. Back in the 15, can you imagine being a financial planner back then? You're doing a whole bunch of planning here at the 80% bracket. Just kidding. We're down at 25 now, which does make it difficult. I always joke, the reason why I have too much gray hair at my current age is because of the tax code, right? If you told me what tax rates are for the rest of your life, I will nail the number you need on pre-tax versus Roth. I'll be able to tell you to the penny. We just don't know that, right? And as we sit here now, we're currently waiting for probably a pretty substantial tax code update as is. So just goes to show you how complicated it can be. I was not a financial advisor back in 1917, but boy, there was a 15-year span there where you definitely could have earned a buck or two if you were doing it the right way. All right, so let's kick that out. Okay, so what does this mean? Well, the whole topic of today's video is, why do we think you should be doing pre-tax savings as a high-income household? And I emphasize high-income household because what happens in this group in particular, the group that we've worked with for over a decade now, is that if you're doing everything right and you're saving pre-tax dollars, there is a big issue coming down the line. And we mentioned this in numerous other videos before too, but if you are a good pre-tax saver, as you should be based on this video topic, right? There is going to be an issue down the line called RMDs, required minimum distributions. For the bulk of us watching this video, that those currently start at the age of 75. And that's when Uncle Sam will start to force you to pull money out of pre-tax savings, right? So that's really important. So we have, today we're sitting here now, and let's just say high income household, 30, what did I write down here? I said, 32, 35, 37% tax bracket is where the bulk of our clients, kind of fall into that range. So that's an important number to keep an eye on. So that's where we are today. So any dollar you save today pre-tax, you're saving, let's just call it 35. You're saving 35 cents on the dollar. And let's just say you did no other planning. You just kind of let that thing ride there, and then you go to retire, you are going to have a massive pre-tax number. Maybe you were doing your 403B, maybe you were doing a 457B in there, maybe you had some side gig, you had 1099 income in there, you're also doing a solo K. If you do it the right way, you likely have a large amount of pre-tax savings. And what's the issue here? Well, go back to what we said at the start of the video. Pre-tax still has to get paid. So, right, you're walking into the door here for retirement. Uncle Sam's the bouncer out front. Hey, time to pay the dues. That's the issue with those pre-tax savings. But we still come back to the idea of, we believe that you should be doing pre-tax savings because those rates are still high. If you can save 35, 37, 32 cents on the dollar, that's a win. The reason why we favor pre-tax so much, though, is because you will likely have this golden window, and we do call it the golden window of Roth conversions. So let me show you this. Let me share my screen again. So let's look at another chart. Again, this is from the Michael Kitch's blog post on this topic. We will also put that in the show notes. So in your accumulators years, your working years, right, you can see the blue. And then there's this gap, this beautiful gap. That's the golden window. That's the Roth conversion window. And then you can see it starts to go back up again, right? And use the blue line as your marginal rate. Green is showing Social Security. Orange is showing RMDs, required minimum distributions. And full disclosure, for most of our clients, we actually don't even plug in Social Security, just assuming as a worst case scenario. Again, most of our clients are under the age of 50. So a lot of things out there can still occur in that time frame. And you can even plug, another income source that's on here is pensions. Now, again, most of our clients, a little bit younger, pensions are kind of like essentially becoming a dinosaur at this point where we don't see them all that often. But depending on where you are currently watching this video, you could also have a pension added into that base number. But you can see all of a sudden, you're in these high brackets here in your working years. You don't drop too much, right? Maybe a bracket or two in retirement because those RMDs are going to force you into those higher brackets. But this little drop here, there's usually two phases of it, right? It kind of depends on when you start Social Security. Also depends on when you retire, right? If you're saying, hey, I'm working until 75, that our window is pretty much gone. Now, maybe you go part-time there. We still have some lower brackets, but in here, we have some lower brackets to work with. Now, depending on your lifestyle coming into it, it can sometimes be hard to get too low, right? Like I'd love to get into the 10 and 12% bracket, but I will say, again, physician community usually have a certain lifestyle they've adjusted to. Now, it depends on what investment accounts we have in there, which is another reason why we say when you head into retirement, we like to have 3 buckets. In a perfect world, they're ideally similar. Usually pre-tax has a big head start in there. But if you have some pre-tax savings, you have some Roth, you have some taxable, right? Like your joint account with your spouse or an individual account for yourself. We like having these 3 buckets because then we can pick and choose based on what the tax code is providing to us at that time. But in this window here, you have lower tax brackets that you should not be wasting. If you take one piece of advice from this entire video, all the videos on YouTube, one of your best opportunities for massive tax savings are likely going to occur in this window. And you do not want to waste those lower tax brackets. So let's just say up here, you're in the 37 and here you drop down to 32. But down here, you might be around 22. You have a 10% arbitrage swing in here where you can take advantage of the tax code. So this is why we favor the pre-tax so much, because let's just say up here, you're saving at 37, right? That's your current highest bracket, 37. And down here, it just drops to 22. Again, this is all going to have to be customized for your numbers, but that's a 15% swing there, right? That's a win. You withheld taxes at 37. You only paid them at 22. I think those are the numbers I said. So let me just make sure I write them down. 37, 22. So you got a 15% swing in there. So you withheld at 37. When you pulled the money out, right, or when you did the Roth conversion, you only paid 22. That is a win. That's a 15% swing there. Compared to, let's just say you never do these Roth conversions. You're going to withhold at, let's just, again, say 37 highest, and then let's just say hypothetically this is 35. Sure, still worked out, but 2% swing now, right? You withheld at 37 to pay at 35. So that's why these Roth conversions, and even here, this little window here before those RMDs start, really anything before RMDs, you likely have some form of an opportunity. And sometimes clients are willing to fill up more brackets for better benefits down the line. And the beauty of these Roth conversions also are, it's going to lower future RMDs. So you're controlling the tax narrative. So when you look at all of this, if you're watching this video as a high-income professional, high-income household, more than likely, you should still be saving everything you can on a pre-tax basis. Again, backdoor Roths, do not waste any pre-tax dollars. But if you do that, you cannot fall asleep in this window here. You have to take advantage of your income stopping or dropping substantially until RMDs start. And again, for a lot of us, who knows what Social Security will look like? We're assuming Social Security starts at 70 for this hypothetical household. And I should say, this is the Michael Kitch's blog report here. They're assuming Social Security starts at 70. So they deferred until 70, got the highest number, which likely makes sense for a lot of high income households. And then RMDs fired up at 75. So even here at this start of Social Security, you still have a little bit of room here for a little bit more arbitrage. But your real big window is from the day you retire to at least 70, likely 75, kind of depend on what Social Security looks like in the end. So let's stop sharing here. It's a good topic. And this is based on what we know today, right? This could all change. And while I do think tax rates will always bounce around depending on who's coming in, who's going out, it feels a lot stickier than what it did, back in the 1950s when we saw, 80s and 90% highest marginal rates. Where now, you start saying that stuff, probably high probability you're not getting elected. So it's a lot stickier today. So not to say that they can't go up substantially, and maybe they will, but maybe they also go down. I think that's probably less likely. But the main takeaway from this video and the main topic for this is because, again, we see these questions coming in on pre-tax versus Roth. And it's not a simple answer, right? For all of us, we need to analyze this. But if you're sitting there as a high income household in particular, and you're already in those higher tax rates, those higher marginal rates, you should likely be trying to take advantage of most, if not all, pre-tax buckets that you can save to. And then when your income stops, slows, and before those RMDs or Social Security or a combination of both start to fire up, take advantage of those Roth conversions. And remember, Roth conversion is taking you're actually forcing a tax bill upon yourself because you're trying to fill up the lower tax brackets. So not like a backdoor Roth. A Roth conversion is a taxable event. If you convert $50,000 from your IRA to your Roth, you will literally see $50,000 of taxable income on your tax return. So keep that in mind. Keep an eye on that. And there's other things. You got to track IRMA. You want to track capital. You want to make sure when you add these numbers in, you are doing the research to say, hey, this is a good number. And also be prepared for the tax bill that comes with it, right? When we start to do Roth conversions with clients, we really like to have cash set aside. We don't want to have to go pull out of investments to pay Uncle Sam. So having that in there, also speak with your advisor or your CPA, your accountant. When you start to do these, remember, you're forcing a higher tax bill. So if you didn't pay enough of your tax bill in advance, you could also get an underpayment penalty. So when you start to do these Roth conversions, it's also a good idea to speak with your advisor or your accountant on, hey, should I be making some quarterly payments to make sure we don't have underpayments? So again, nerding out a little bit, added some extra context there, but fun topic. If you have questions on this one, drop those below. We also have our link in the show notes there too, where you can send us private questions as well, and then we can answer those and even make more case studies out of it as well. Hopefully it was helpful to see those charts. The Kitchens team always has really good visual aids, so I feel like that added a good context to it today. But as always, thanks for hanging out with me for the last 15, maybe 20 minutes today, but add a little bit more detail to it. As always, drop us questions, comments, anything that you want to hear about and see, drop those below or send us those private notes. And as always, I will catch you on the next video.